So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer the question, how to determine IV rank. So IV rank is a favorite metric of options traders, in particular option sellers, and over the last couple of years it's gained a lot of popularity, and you can actually see IV rank in many different platforms. We have a IV rank calculated using our own software here at Option Alpha, but inside of Thinkorswim and Tastyworks and some other brokers as well, you have the ability to determine IV rank or IV percentile. Now in today's show, we're going to be talking about IV rank because it's the very quick and dirty way to look at and compare different securities on a normalized implied volatility basis. And so what I mean by this is that when we typically see implied volatility, what we are looking at when we see implied volatility is the raw or real implied volatility of the security. But that implied volatility is not normalized when we try to compare one security to another. So for example, if we have a tech social media company like Facebook, and we are trying to compare implied volatility in Facebook to say something like a large financial like Goldman Sachs, we might see on the outside that raw or real implied volatility could be wildly different. So Facebook might have implied volatility of 45%, and Goldman Sachs might have implied volatility of, say, 10%. And so if you just look at this metric on the outside, you're not getting the full picture because Facebook is a social media tech company, which potentially should have more implied volatility and will fluctuate more in the future. But we don't know if that 45% that Facebook is showing right now is actually relatively high or relatively low. They could be a relatively low reading for Facebook, and maybe their real volatility is typically much higher than it is right now at 45%. And same thing, we don't even know if that's potentially a high reading. Maybe 45% implied volatility in Facebook is actually fairly high, and it should be much lower historically, or it has been much lower historically. So this is where we introduce something like IV rank. And what IV rank does basically is it normalizes or neutralizes the impact of these individual implied volatilities and makes everything compatible on the same scale. And so it takes the high implied volatility or seemingly high implied volatility of Facebook and the implied volatility of, say, something like Goldman Sachs, compresses them down into the same basically 0 to 100 scaling mechanism so that we can accurately look at each individual security and say, okay, Facebook or Goldman Sachs or whatever you're looking at has relatively high implied volatility based on its historical trading range. And so the way that we use IV rank is to use a very simple formula to calculate this. And so all you need to do basically is take the current level of implied volatility, subtract the 52-week low, and then divide that number by the difference between the 52-week low and the 52-week high. So you're basically taking the current implied volatility reading, subtract it out from the low, and dividing it by the full range over the last 52 weeks. Now, some people might use implied volatility not on a yearly basis and could use implied volatility on a weekly basis. I've seen people use it on a monthly or a quarterly, semi-annually. I think the most standard default is to really use it for about a year. So we go back in time about a year to get the true range of the security as far as implied volatility goes over the last year, and then use that as the basis for determining where the security is trading now. So again, what this does, and I'll use an example here, is it takes this entire massive range that a company could be trading in, and it basically tries to normalize it down to the range or rank that the current level is in right now. So let's say that we have a company that's low implied volatility reading over the last year was 20%, and the high implied volatility reading over the last year was 70%. Well, right now, let's say that the company is trading at 45% implied volatility. Well, that would represent about the 50 rank between a low of 20 and a high of 70. And so this is, again, a very easy way to just say, okay, look, if the range is this and this, then the current reading is around the 50th rank. If we were to take 20 as our low, make that basically like our zero barrier, and take a reading of 70 as our high end or 100 barrier, then the current reading of 45 is around the 50th rank. And so when you do this over multiple securities, then you get a much better idea of which securities or which ticker symbols you might end up making trades on actually have implied volatility that's above or below their average range over the last year. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.